Sorry, ladies and gentlemen, thank you for standing by and welcome to AmBank Group Q1 FY2012 results announcement conference call. At this time, all participants are in the listen-only mode. There will be a presentation followed by a question and answer session, at which time, if you wish to ask a question, you will need to press star 1 on your telephone. I must advise you that this conference is being recorded today, Monday, the 15th of August, 2011. I would now like to hand the conference over to your first speaker today, Mr. Ashok Samamurthy. Thank you. Please go ahead, sir.
Hi, this is still Ganesh. Thanks everyone. Thanks for dialing in. This is AmBank Group's investor presentation, Q1 FY2012 results. And for the first time, we're also having a live webcast. And for those of you who would like to have that information, you can go down to www.livestream.com/AmBank Group. And you can watch us, listen to the presentation, and also have a live chat, and at the same time listen to the teleconferencing. So now over to Ashok.
Thanks, Ganesh. Thanks, folks. Just moving on to the highlights for the first quarter. We've had a good start to the first quarter of financial year 2012. As you might remember, our principal objective for the next 2 to 3 years is to help improve returns to our shareholders, and we've done that in terms of getting our profits up 20% and return on equity up for the quarter as well. The profit growth has been underpinned principally by the activities in the non-interest income space, as well as we've had lower provisions coming through in the first quarter. We've had good deposit growth and targeted loans growth, which is a continuation of our strategy that you've heard us talk about before. But we've had a much higher NIM compression for the first quarter than we had anticipated, and I'll take you through that in a bit more detail later in the presentation. Our capital levels are well positioned for Basel III and the dividend payout ratios that we have indicated to the marketplace. And we will continue to execute our strategic themes, which you've heard us talk about in the past, and leverage on ANZ's international connectivity as one of the principal themes within that. If I could then take you through to some of the details behind that, which is on the page after that, you can clearly see that profit after tax minority interest is up just under 20% compared to the same period last year. We've had return on equity up 1.6% compared to the same period last year. And the other ratios around the financial performance are very sound as well, and have shown an improving trend. In terms of the divisional contributions, again you can see that we've had broad-based growth amongst the various divisions. All the divisions apart from Life have shown improvement over the same period last year. In the case of life insurance, we held back transferring some profits to the shareholder funds, pending some further work that we're doing around bank assurance and the agency models. And again, I'm happy to take more questions on that as we go through the presentation. Moving on to the asset and liability growth, you can see on the page after that, which is slide 5, we've had lending growth of in the order of 10%, slightly below system at the moment, but that's again consistent with our targeted growth strategies coming in in the non-retail sectors. Our customer deposit growth and our CASA growth continue to do quite well. Our impaired loans ratio continue to come down, and at 2.96% we believe is slightly better than the industry average at the end of June. And our capital ratios are well positioned, as I mentioned at the outset, if one were to include the profits generated in the first quarter, with a common equity ratio of 8%, Tier 1 of 10.1, and total of 14.4 are pretty sound ratios. In terms of the loan deposit ratio, we have maintained it at below the 90% mark at 87.1, but that's got some ramifications in terms of the net interest margin that we have, and when I take it through that slide I'll explain that a bit more in detail. Cost income ratio continues to be sound. Moving on to slide 6. Our strategic priorities and our medium-term aspirations remain the same. This is just the first quarter refresh. You've heard us talk about our strategic priorities, including profitable growth, rebalancing, diversification and new business development, growing a non-interest income over time, as well as deposit growth, and in particular within that current accounts and savings accounts, and the added element of customer centricity that came in around 3 months ago. Those strategic priorities remain the same, and our growth levers that we took you through 3 months ago remain unchanged at the end of the first quarter. Moving on to more details, typically at this point in time, I would take over from Mr. Chia, who unfortunately sends his apologies, given we deferred it from last week to this week. So now the details is the classic CFO speak from here on in. So moving on to slide 9, we're just taking a look at our income statement. As I mentioned at the outset, our profit growth has been underpinned by high non-interest income and lower provisions. In particular, in the non-interest income space, you'd notice that we've done very well in our markets activities, which is around trading and investment income, but other forms of non-interest income have done quite well as well. The non-interest income from markets arose in reasonable part due to a buy market flattening, which meant that our fixed income portfolio did quite well, as well as we took the opportunity to lighten some of our available for sale portfolio into a reducing interest yield space. On the interest margin side, clearly that was one where the faster NIM compression was due to a number of factors, some expected and some unexpected. I think I'll dwell a little bit more on the unexpected factors. The first one was the SRR increase, which came in at a pace that was much quicker than what we had anticipated. We had almost 3 successive increases in SRR, the reserve ratio, that impacted our margins in the first quarter and will continue to do so for the second quarter as well, given the last of them happened in early July. Given we're running a much healthier loan deposit ratio, we've also had those funds that we had raised placed in the interbank market. And so what I would call that as the base effect, in that you had more interbank funds, but those interbank funds earn you income at a much lower rate compared to other forms of lending activities. We've also had some retail mix effects, in that we had some growth coming into the mortgage space at a slightly quicker pace than what we had anticipated, because of some historical loans that we had approved, which got drawn down during this period, as well as the fact that falling longer term interest rates meant that we lightened the AFS portfolio, and that again contributed to some reduction in our net interest margin. Nevertheless, these are things that one would need to manage on a dynamic basis, which is what we've done. In terms of our divisional contributions on the page after that, clearly I mentioned at the outset that apart from life insurance, all the other divisions have contributed positively to the growth outcome for the first quarter. We transferred lower profits from the life insurance entity into the shareholders in the first quarter. We anticipate that bouncing back and expect reasonable outcome for the full year. The outcome for the full year is likely to be, at a minimum, something similar to what transpired last year in terms of profits. Our operating segment contribution was impacted by the higher funding costs, where the impact of the SRR, the reserve ratio increases were held centrally, as well as we had some prudent acceleration of some of the specific accounts that we had. But overall, I would say that we can still claim to having a well-diversified divisional contribution to the growth outcomes for the first quarter. Moving on to slide 11. We've had growth in non-interest income coming in at a much faster pace, and you can clearly see that growth has come in from the trading and investment income activities as the mainstay. A reasonable part of that came in from growth in FX and derivatives, and again, I'm happy to handle that as part of Q&A, but the largest part of the contribution came in from lightening our AFS portfolio and even our held for trading portfolio during the first quarter. And that happened in a period when the market yields continue to flatten and fall. Our NIM compression, as you can see in the bottom part of the page, has come in at a much faster pace, but again, as I've explained before, some of that was to be expected and some was unexpected for us. And again, I'm happy to take more questions on that as part of Q&A. Our loan loss provisioning continues to fall. At the end of the first 6 months, we had a 40 basis point charge, which is lower than what we had indicated to the marketplace to expect from us. A part of that is we had some healthy recoveries, some lumpy healthy recoveries that came in the first quarter, contributing probably roughly in the order of 7 to 8 basis points reduction to our loan loss charge. But the overall outcome for the first quarter was very good, as well as our impaired loans ratio continue to drop, and our loan loss coverage continues to increase. We do know that we're moving into the space in the future when one would expect more uncertainties, and we need to manage our asset quality on a dynamic basis going forward into the latter part of the financial year. But for the first quarter, a healthy result. Slide 13 looks at our impaired loans ratios, and as you can see, there's nothing that's completely unexpected in terms of the ratios of new impaired loans or our ability to convert them. We've had some slight recoveries that I just mentioned before, and our write-offs continue to be around about what it was last year. Again, not a major divergence from what one would expect in the early part of the current cycle. Our loans portfolio rebalancing continues towards non-retail. As you can clearly see, our non-retail contributes 38% of the overall loans in the group, up from 34% same period last year. Clearly, you can see that the faster growth is coming in the non-retail space, with both business banking and corporate and institutional banking both having a healthy growth outcome for loans. In the bottom part of the page, you can clearly see that our variable rate loans continue to increase at 54% compared with 38% 3 years ago, and that will continue out into the future, given our strategy is to ensure that we manage our balance sheet risks on a dynamic basis. Slide 15 simply looks at our funding profile, which continues to be stable. There is no material change to the broad storyline that you heard us talk about 3 months ago. The senior notes and the term funding that we did, were all well distributed out to the maturities, and our funded assets financed by equity, customer deposits, and long-term debt continue to be healthy at over 95%. In terms of shareholder returns, you can clearly see that there's been a big jump in return on equity, in large part driven by the headline growth of profits compared to the same period last year. Return on equity again is underpinned by the profit growth that we've had in the first quarter, with sound earnings per share, and we believe we're still on track largely to deliver our aspirations on ensuring a dividend outcome of somewhere in the order of 40 to 50%. Last year, as you know, we declared a dividend payout ratio of around 40%. Our capital levels, which I spoke of earlier, is well positioned for Basel III and target payouts. As part of our risk appetite settings, given what we've seen happen in the region, for example, Singapore or globally, we have tweaked our risk appetite framework targets marginally, particularly around common equity Tier 1 ratios, where we have said we need to now maintain it at around the 8% mark, plus or minus 1%, subject to further guidance being received from Bank Negara. And we've also marginally increased our the range that we've given ourselves for Tier 1 and for total risk-weighted CAR outcomes for the group. But overall, where we are today is well positioned to handle what Basel III might throw at us, and target payout ratios, assuming that Bank Negara doesn't take an extreme stance on this, which they are in the throes of considering at the moment. We haven't heard anything back from them on what the current thinking is around capital. Our strategy and outlook remains unchanged. You've heard me talk about it in a lot of detail at the end of the financial year only a few months ago. Our medium-term aspiration to become Malaysia's preferred banking group with international connectivity remains. And we've talked about the measurements being around customer satisfaction, financial performance, and diversification and sustainability. None of those broad themes have changed, and hence I wasn't going to touch on that. You have heard me talk about transaction banking coming out as a separate product division in its own right at the end of the year, and we've just got the aspiration out there to be in the top 5 in that space by 2016. Our business transformation and growth plans for the current financial year again remains unchanged. It's only a first quarter refresh, and you heard me talk about this in a lot of detail only 3 months ago, and I'll leave it be for more as part of the Q&A that you might ask. In terms of profit targets for 2012, we maintained it. It's only the first quarter result for us. We know we're trending, moving to potentially uncertain times in the latter part of the financial year. We've had a very strong start to the first quarter, but we do know that we need to be nimble and manage through a slowing growth cycle moving forward. You would have seen some minor changes to some of the wordings in the various divisions, and the main one I would say is the life insurance, where we've said, we expect flat profit contribution for 2012, and we are looking at how we can put more emphasis in the right areas like bank assurance and a better performing agency workforce as part of that. Outside of that, we've said the markets activities and the IB activities are all have started the year well, but we'd expect a slower level of activity going into the latter part of the financial year. As I said at the outset, we haven't changed any of our medium-term aspirations, which is on slide 12, notwithstanding we've had a very good start to the first quarter. We've held on to it pending further clarity on where the global economy is headed, and in that space, how the Malaysian economy is performing. And so our MTA guidance aspirations are still broadly consistent with what you heard us talk about only 3 months ago. In terms of outlook and priorities, look, we think Malaysia is positioned to be resilient in the midst of what's happening globally. We expect strength in private investment, consumption, and the economic transformation program that will progressively kick in. But we do recognize and acknowledge that the domestic economy is not immune to what's happening globally. Our monetary policy, it remains accommodative. We know with an OPR of 3% and an SRR of 4%, we've said still there's potential for further tightening, but Bank Negara again have been very proactive in the way they manage it, and at the moment it's the global events, I suspect, would play a bigger role in how they see it evolving. The banking sector and the economic transformation program with CNP2, will continue to do reasonably well, albeit with probably a bit more volatility in its earnings streams over the next 12 months to 2 years. And we've talked about irrational pricing being a concern. It continues to still be a concern, notwithstanding what's happening globally. But again, there's more that one could answer as part of Q&A. Our strategic priorities remain unchanged. On that note, I was going to stop, pause, and take questions.
Ladies and gentlemen, we will now begin the question and answer session. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press the pound or hash key. Your first question from the phone comes from the line of Kyriel Rifai from UBS. Please ask the question.
Hi, thank you for the conference call. I have 3 questions, if I may. Firstly, is on the gains on the AFS book. Do you think this potential gain is sustainable going forward? And my second question is on the FX and derivatives platform. Can you update us on the progress, and can you give us some guidance on the potential contribution from this business segment? And lastly, on your asset quality, what is your guidance for the credit cost for FY12?
Hi, Cairo. In terms of the first one, look, it's the AFS portfolio sell down gains are unlikely to be repeated. We took an opportunity to lighten in a period when we thought the market flattened very quickly, and we expect as I said, the monetary policy to remain accommodative, as well as the potential for further rate falls in the longer end of the curve are likely to be less muted compared to what's happened in the recent past. And hence, we expect, one might expect the sell down to continue to give a bit more profits into the second quarter, but as we start coming out of it into the third and fourth quarters, we'd expect much more of a modest result coming out of any activities in the fixed income space. In terms of FX and rates, there's a slide here in the back part of our presentation, which looks at the divisional contributions.
29.
And slide 29. And if, in that place, you can see FX and derivatives contributing 17.4 million in terms of profits for the first quarter this year, compared with 7.4 for the first quarter last year. And that's a very healthy result. And we are comfortable that we'll continue to do well in that space, taking advantage of both the platform we built, the customer needs, and the potential volatility that one would expect to see here, which customers will need hedging activities for. In terms of asset quality, we believe that asset quality will continue to remain relatively healthy through the course of the year. We do know that as I said, the global events and its lag effect on Malaysia will mean the emergence of potentially higher credit costs as well as impairments in the latter part of the year. It's too early to really call. We are looking at the various portfolios within AmBank to ensure that we are proactively managing those in the light of potential slowdown that one might expect and the lag effects of what one would expect to happen in the latter part of the financial year. Now, Malaysia typically, based on past experience, has a lag effect of around 6 to 9 months, and I'd expect that probably to happen this time around as well. So, in terms of our loan loss charges, at the beginning of the year, we broadly guided the market to expect a 60 basis point cost. Given our first quarter performance, it's likely to be lower than that. We would probably expect a charge of something order of 55 to 60 basis points. But again, as I said, it's a tough one to forecast today, given one doesn't know precisely how long the global issues are going to last and how deep the impacts on Malaysia is going to be. And reading the papers, and most economists appear to suggest there's even a 30% probability of a double dip. And in that scenario, the broad guidance I've given you might need to change. But where we are today appears to suggest expecting a charge off around 55 basis points for the full year may not be too far away.
Right. Thanks. Just a follow up on my first question on the non-interest income. I thought of getting your views. Given that there's this environment of heightened risk aversion, also a slower global macroeconomic environment. Do you think that there's a huge risk that the deal pipeline is going to dry up in the second half of this year?
It's an interesting one. We've always said that the deal pipeline is a function of how the economic transformation program pans out. When I talk about Malaysia being relatively resilient in that space, it's a function of that transformation program rolling out over time. As I said, the first quarter was good. The first half appears to be decent, and then we'll have to look into that after that. And we do expect typically the second half of the year for us would be slower than the first half, and some of that might be simply the seasonality effects of that hitting into December, getting out into the March part of the year. But having said that, we also know that the economic transformation program continues to have momentum behind it, and it's as long as that remains sound, the deal pipeline may be okay.
Right, thanks.
Thank you. Your next question comes from the line of Chi Tay of Merrill Lynch. Please ask the question.
Hi, good afternoon, gentlemen.
Hi there, how are you?
Hi,
Good, thanks. Just a couple of things I need to clarify. Firstly, on the NIM compression, I know you mentioned that some of it was unexpected as well as the SRR hike. Any way you can quantify the mixed effects as far as the balance sheet shifting from corporate, from retail to corporate, and to the extent of whether this actually becomes the sort of a normalized trend going forward?
Yeah, good question. So, if you take a look at slide 11, There are two elements to it I'll briefly touch on. I mean, the first element is what's happened to the cost of funds. And if you take a look at first quarter of last year, our cost of funds was 2.86%. That increased to 3.08% this year. And that difference of 17 basis points of that was contributed to by the term funding that we raised. And we raised the majority of the term funding in the latter part of last year, for which we had some run rate impacts in our cost of funding through the course of last year. This quarter compared to the same period last year was, would have had the highest impact, given there was very little funding, if any, that was raised in the first quarter of last year. That's on the funding side. In terms of the asset side, the SRR impacts have contributed to a margin reduction of something in the order of 4 basis points. We've had the interbank, I call it the interbank base effect, in that we're running a lower loan deposit ratio, and then we are holding a larger quantum of lower yielding assets in our portfolio, and that's had an impact of around 8 basis points. And that's one that's manageable. I mean, we could get our numbers back towards the 90% loan deposit ratio and reduce the quantum that we're placing into the interbank market, but just simply the base effect in the first quarter has cost us around 8 basis points. And when I talked about mix effect, the mix effect between retail and non-retail is consistent with our strategy and should have been anticipated by us. It's just within retail banking, we've had slower growth coming in a higher margin portfolio, which is auto financing, and slightly higher growth coming in a lower margin portfolio, particularly the new business we're writing, which is in the mortgages portfolio, and that's contributed to a mix shift within the retail portfolio that's cost us a bit more. And then the last of that is the AFS sell down and holding more shorter term assets in the AFS and the held for trading portfolios, which has contributed to margin contraction. So when I talk about the expected and the unexpected, I've given you the 4 reasons on the asset side, which have all been relatively unexpected.
Okay, thanks. Second question is on the Islamic banking. I noticed there's a strong pickup quarter on quarter. Any seasonalities there in terms of the numbers there in first quarter?
You're talking about loans or profit contributions?
Profit contribution more specifically. There's 20% quarter on quarter change.
Yeah. Look, you might remember that we talked about some changes in the market landscape around the regulatory changes we had around our co-op business, the personal financing business that we do with civil servants, around July of last year when co-op could no longer do that business. And then that meant that our ability to rely on the way we used to provisioning started diminishing towards the latter part of last year. And so we continued to provide higher quantums of money in the latter part of last year in Islamic banking, Islamic financing compared to this year. Now that culminated in us being taking a prudent charge in the biggest quantum of it came in the third and the fourth quarters of last year. So if you're doing a Q-on-Q comparison, that's the principal reason for why that Islamic banking contribution has increased compared to the previous quarter.
I see. Okay. Lastly, I know maybe a little bit premature still, but any updates on as far as the strategy on the connectivity in that?
Look, we continue. I mean, there will be some progressive announcements on that starting probably next month. So I'll leave it at that, Chin Seng. So you'll have to wait when we do the announcements on that.
All right. Thank you very much.
Thank you. Your next question comes from the line of Modi from JP Morgan. Please ask the question.
Hi, good afternoon, gentlemen. Few questions. First on capital, I saw the CET1 target has moved to 8% plus minus 1. Assuming it's 8% plus 1, do you think 40% dividend payout is possible this year?
If it's plus 1, we would need to go back and re-examine it, Harsh. So the numbers that we put out are still based on maintaining a target ratio of around 8, with a plus or minus 1% coming in more as a function of what we've seen some of the regional markets do, in particular Singapore do. And so the board said, at the board discussion, we said, let's give ourselves some headroom to change it without having to go through a formal process of announcing it, to going by the board and announcing it to the shareholders. But our payout ratios are also based on maintaining a CET1 of 8%.
Okay, and AFS volatility, as in, I hear that second quarter also you think there would be some profit booking which we saw in first quarter. But has the recent volatility kind of clouded that outlook, or are you still okay with your AFS positions?
Look, I think the lightning that we started into the bear market flattening in the first quarter, I suspect, was the right strategy and continues to be the right strategy today. Long-term rates, continue to come off, but the pace of reduction has slowed in the recent past. It might remain at these levels, but we do not expect a substantial decrease in the longer-term rates. You're now talking about 5-year rates recently breaching, something in the order of 3.3%, and if you talk about 1 month, CLIBOR at around 3.1. So there's not a great deal of headroom for it to narrow further, unless there's a reduction in OBR, and that's one will have to wait and watch and see how things transpire.
On margin outlook, Ashok, are we seeing any thaw in competition on the mortgage pricing, because we have seen that almost all the banks are almost at point of maximum pain in terms of mortgage pricing. So do you see that in the market? Has there been any degree of easing on the mortgage pricing?
I wish we saw that, Harsh. The short answer is at the moment we're not seeing any.
Got it. My question, Ashok, this is more on a bit macro. Across the region, there remains some worries on US dollar funding squeeze. Do you see that in your book? And second, is it a worry at all given your position?
Look, we're a largely domestic bank, Harsh, so it's not a major worry for us. We've seen some recent trends towards that, and literally when I say recent, probably in the last 10 days or so. But it's not a worry for us, not in any significant way. We have raised some stable funds even in the US dollar space, with support from ANZ in last quarter of last year, which means that to the extent there is demand for US dollar funding from our side, we've got enough to continue to do that.
Got it. Thank you so much.
Thanks, Ash.
Thank you. Your next question comes from the line of B. Wei Lu from CLSA. Please ask the question.
Hi, good afternoon. Yes, I just have a question of this fee income. I saw a sharp increase for your loan fees that went up by 69% quarter on quarter, but your loans only went up by 10%. Is there some seasonality to it? And also, in terms of that, overall the fee income went up by about 21%. Do you think that's sustainable?
Look, again, we've done reasonably well in a range of activities linked to what's happening in investment banking as well as in corporate institutional banking QA. So, our strategy is to continue to grow on non-interest income, and within that, do well in fee income. But to an extent, we will expect to see volatilities depending on what happens in those two spaces. If the need for loan arrangements or debt arrangements diminish, then our ability to continue to generate outperformance in fee income will diminish with it. But as I've always said, our strategy is clear, which is to generate the right type of non-interest income in the portfolio, and we will continue to remain focused on doing that. But again, the latter part of the year would be an interesting one for us, where you naturally see a slowdown in both spaces. One should expect to see a slowdown in both spaces, and hence our ability to continue to generate that will diminish.
Okay, can I just follow up on that. Does that mean that the first quarter jump in loan fees is mainly because you did a lot of syndicated loans and that caused the jump?
Okay. Clearly, some of that came in from those activities.
Okay. And also, I noticed your operating expense line, the personnel cost actually went up 13% quarter-on-quarter, faster than the overall operating expense growth. What are the key reasons behind that?
Look, typically what will happen is that you've got your all the salary increases come in the first quarter of the year. So, you know, you've heard me talk about the awards last year result in an increase in the total cost associated with the unionized staff, and we said there will be flow-on impacts from that into the non-unionized staff space. And that's clearly happened in the first quarter of this year. We've also had increasing headcounts to execute our strategic themes, which have contributed to the increase in personal cost. Those would be the two main drivers of it. I would expect non-personal cost lines will see an increase in the latter part of the year, consistent with what you've seen in the previous years as well. We typically end up, having some of the projects come on stream further down the track, increase in marketing spend toward the latter part of the year, and so on and so forth. And that trend, I suspect, will continue to happen this year. But again, it's one where we will maintain a watching brief. If the economic slowdown, happen at a faster pace, then we need to be ready to manage our expenses more tightly.
Okay, thanks.
Thank you. Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. The next question comes from the line of V. Tesco from Vanderlei. Please ask the question.
Hi, Ashok. Good afternoon.
Good afternoon.
The question on the gains that you booked on the lightening of your AFS and trading portfolio. I was just wondering what sort of amount are you talking about you booked for the quarter?
Look, the easiest reference point for you would be to take a look at our actual income statement itself. So if you take a look at our non-interest income line under A20, you notice it's in the order of 50 to 55 million thereabouts. Let me just give you the exact number. So operating income, so if you take a look at net gains on financial instruments available for sale, you've noticed that 20 million was what we made same period last year. 70 million was what we made in the first quarter this year. So that gives you an order of magnitude as to how much the lightning helped us.
Right. Okay. Thank you.
Thank you. Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. The next question comes from the line of Julian Hua from Nomura. Please ask the question.
Hi, Ashok.
Hi, Julian.
Just a question on margins again. I remember you mentioned previously that you're positioning your balance sheet for increases in the interest rates. I'm wondering what your thinking is about the direction of interest rates and how the balance sheet is being structured to meet the future changes.
Very good question, Julian. I think our balance sheet still is positioned for increasing interest rates. However, with the events of the last 10 days or so, Galco is in serious discussions about where it's headed. So we think whilst the longer term trend is still likely to be one of increasing interest rates, the next 12 months is going to probably mean rates might remain at lower levels than what we previously anticipated. So we are taking a relook at our strategy on how we would like to position ourselves in the short term, i.e. over the next 12 months. But a longer term view on interest rates is still one of increasing, being on an increasing trend. But again, we haven't yet concluded on what we intend to do in the short term. It's one that we'll have to wait for a bit longer to understand, how the global events impact on the Malaysian economy, and then reconsider that in the light of it. You'd expect probably us to come out with a better response probably in the next 3 months or so as we do the half-year results.
Okay, great, thanks.
Thank you. Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If there are no further questions from the phone at this time, I would now like to hand the conference back to your presenters today. Thank you. Please continue.
Thank you. We're still waiting for questions from the web. If there's any questions from the web or any other callers who may have questions through teleconferencing. Still have about 15 minutes more.
Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. We do have a follow-up question from the line of B. Wei Lung from CLFA. Please ask the question.
Hi, on your deposits, right, earlier you were locking in long-term FD at higher rates. Is that part of the reason why it's detrimental to your savings now, and have you stopped those kind of promotions, and what will be the focus in terms of deposit growth ahead?
Hi, Chiwei. Look, as I mentioned, we raised a reasonable quantum of term funding between March of last year and December of last year, something in the order of just under 8 billion ringgit worth of term funding. Now, that meant that if I take a look at the current quarter versus the same period last year, the cost of raising that, there was in the order of 17 basis points impact to our net interest margin. But it gave us much greater ability to raise stable funding in a period when we felt we required it. The future quarter-on-quarter impacts from that term funding will diminish, as some of that term funding that we raised would be in the run rate in the last year's cost of funding. So in terms of deposits as a strategy, customer deposits still continue to be a high priority area for us. Within that, current accounts and savings accounts clearly is the number one priority for us, and we're doing a whole range of initiatives in that space. A reasonable part of which you'd have heard us talk about as part of the full year results, around looking at ensuring that our branches are located in the right places. The number of branches we have is appropriate given the customers we have. Relocating some of the branches where we believe it needs to get relocated. Ensuring that we refurbish them in the right areas to ensure we attract the right kind of foot traffic. Looking at campaigns from time to time that are built around ensuring that we get sticky deposits. You've heard us talk about payroll accounts. You've heard us talk about ensuring that we've got the right offering in cash management and transaction services, and so on and so forth. And all those initiatives that you've heard us talk about in the past, expanding our ATM footprint and so on and so forth, still continue to remain as of strategic importance for us, and we'll continue to remain focused on that. So growing customer deposits in that space, CASA is important. In the current quarter, for example, we're in the throes of opening 4 new branches, and those kinds of things which will enable us to get the right footprint and occupy the convenience space amongst the customers will continue.
Okay, thanks.
Thanks, Ewan.
Thank you. Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If there are no further questions at this time, please continue, sir.
So why don't we just give another 30 seconds and then maybe Ashok just maybe mention the concluding remarks.
Yeah. Okay. Look, let me just finish the session today by just making a few remarks. The first one is we've had a good start to the first quarter financial year 2012. We believe that we will manage our businesses on a dynamic basis, given we might potentially be headed towards a period when growth might be slower as well as more uncertain, and hence we are aware of that, and as a management team we'll continue to manage our business on a dynamic basis, depending on what we believe the interest rate outlook would look like as well as the credit outlook would look like. We do, however, believe that Malaysia is positioned to be resilient. The macroeconomic factors are pretty healthy, with the economic transformation program progressively continuing to provide Malaysia with a differentiator compared to some other regional markets, at least in our view. And as long as that it gets executed well, that gives a certain amount of protection for the banking sector within that. However, we also do know that the global events will have some impacts on Malaysia that we need to be able to manage over the next year or so. And the latter part of the year will be more challenging than the earlier part of the year. We broadly maintain our earnings aspirations at this point in time, pending further clarity on where that is headed. And as we do further work on it and as we get further clarity on it, we will come back to the market and keep you updated on it. But nevertheless, we believe it's been a good start to the current financial year. On that note, thank you, folks.
Thank you, everyone. And just to let you know, by 5 o'clock today, or maybe by 4 to 5, you'll be able to download the video conferencing and also the teleconferencing notes at our website. So everyone, thank you, and have a good evening.
Ladies and gentlemen, that does conclude our conference for today.